Hello, and welcome to this episode of Your Questions Answered with me, James Church, the author of the best-selling book, Investable Entrepreneur. Now, this week we have a question from Shane Millsom, who asks, what questions can I expect to be asked by an investor? Now, obviously that's quite a broad question and it could be a whole number of things. So to get specifically into the detail of this would take too long, and I'd need to know much more about Shane's business, the stage in which he is investing, whether it's a sort of pre-seed, seed, Series A round or beyond. But in principle, there are four key kind of areas when it comes to an investor's thinking. So there's these four areas and there'll be questions around these four themes. So the first is proof. The first thing investors want to understand is your current proof. So proof might be, if you're a later stage company, actual customer numbers, traction, what your conversion rate is, how your marketing's going, how easy it is for you to attract and retain customers. This is all proof that your business has the ability to scale. If there's already a good growth curve over the last few weeks, months, years, then you have good proof that if I was to give you investment, then you could continue that growth. If you're in an earlier stage business, this idea of delivering investors proof changes slightly. It becomes less about traction, less about the actual revenue that you've generated, but more kind of proof of concept, product market fit. So you have to make sure that you have some level, some form of product market fit. And obviously the more that you're raising, the more this needs to be robust, and the more of this proof that you need. So in the very, very earliest stages, it might be some things around, you might do some focus groups, you might do some questions and Q&As, some surveys, you might talk to industry experts, and then you might start to launch a proof of concept of a very early stage MVP, and you might have some beta users and you can get some feedback and so on and so on. So you keep building proof points as you go through your fundraising journey. So the earlier you are, the less tangible proof of kind of customers is needed, but more kind of qualitative proof of kind of interviews, questions, market sentiment, all of those types of things come into play. So the first thing is you're going to need to prove how much proof you have around your concept, that the market wants it, the market needs it, and that there's an opportunity to grow a business with the concept that you're presenting. So that's the first thing, proof. The second thing that investors are looking for, and they're going to ask questions around, is your underlying assets in the company. So a lot of founders love to focus on the revenue, and yes, your revenue is a great indicator, but the revenue itself is not the only thing that they want to know about. So you need to understand, or the investors want to understand, the underlying assets in the business. So things like the IP. What IP have you built and do you own? And how valuable is that IP? Or what IP are you planning to build in the future that they will own because they've invested in you? So what kind of underlying assets around IP are you going to have, and how valuable is that going to be to the company in the short and long term? Things like customers are really valuable assets. So how many customers you're going to have, your current customer database, how many customers you plan to have in the future if you grow your company to the state at which you expect it to be. Just bearing in mind that these assets are the things that drive the value of the business. And WhatsApp famously exited their business for billions of dollars and had Microsoft and Facebook fighting over the purchase of that company, having not made any revenue at all. But what they did have was a really valuable customer database. They had almost the whole world using their platform. So they had very valuable customer database, which in itself was worth billions. It was nothing to do with revenue. It was all to do with those underlying assets. Other underlying assets that investors will be curious about is your kind of systems and processes. So that might be your technology or your physical systems, your systems around sort of onboarding and culture and HR and all of these things that are going to lead the company to actually be able to operate itself efficiently at scale. So IP, customers, systems, all of these underlying assets in your business that are going to make it successful. Now, again, the later stage you are, the larger the amount of money you're trying to raise, the more these need to be more robust and more figured out, and actually have some of them in operation rather than just the theory of them. The third of the four kind of themes that investors kind of will ask questions around is implementation. What's your implementation strategy? It's all well and good having a great idea, but it's the entrepreneurs who can implement that idea and turn it into some kind of commercial success that ultimately end up succeeding and creating a profitable and exitable business and generating massive returns for them and their investors. So implementation is absolutely a key question that investors will have. The more you can do up front to explain and express your implementation strategy, how are you going to take this to market, how are you going to attract customers, how are you going to grow and scale, how are you going to create those systems, attract those customers, build that IP. When you are able to express your implementation strategy for creating these valuable assets, then an investor is going to be much more willing to invest in you. And again, the earlier stage you are, the more it's theory and the more you're talking about what you would do with their money and what you're going to do over the next 4 to 5 years. The later stage you are, if you're raising your Series A or Series B, they need to see evidence of a successful implementation strategy in the past, having got you to this point, so they have the confidence to invest in you moving forward. It's also useful to point out that when it comes to implementation, especially in the early stages, this is your ability to implement. So not just what you're going to plan on doing, but also the investor's belief in your ability to actually pull it off. So you might want to leverage previous experience in previous roles with previous companies where you can demonstrate that you are able to take a plan, implement it, succeed, get results. The more you can do that, the better you are in terms of convincing an investor that your business is the one to back. And then the final area of the four pillars, if you like, that investors will want to understand and want to ask questions around is the risk, the financial risk to them as an investor. So they're putting their cash into your business in the hope of getting a financial return at the end of it, a much higher return than they would if they were to invest in the stock market or the property market. So they need to understand that risk. Now they know you're extremely high risk, that's a given. But what they want to understand is how through proof, through assets, through implementation, those other pillars, you're planning on reducing their risk. How are you going to reduce that risk? And do you understand what risk you're actually asking them to take? How much money is actually going to be needed over the long term to get you to the position in which you want to be to deliver that kind of return on investment? Is there going to be dilution along the way? Is there going to be a number of rounds of investment needed? Are they going to need to keep pumping money into this to get it to market, to scale it, to grow it, to exit it? What's the financial risk to them? Is it just a one-off investment and then they get their return in a few years' time? Or is there a number of rounds which they either need to keep investing long-term in this company or they need to be happy for dilution? So what's the risk to them? What's the risk to the company failing? What external risks are there from the wider market, the economy, political decisions, social decisions, economic decisions? All of these things that you have no control over, how do they affect the operations and the success of your company, and what risks do they pose, and how are you going to mitigate those risks as a founder to make sure that your business succeeds? So they're the four things: proof, assets, implementation, and risk. They're where you can expect to get a lot of questions. And if you can satisfy those answers, then an investor is going to be much more confident in investing in you and your business. So I hope that helps, Shane. I hope that helps a number of other of you who are watching this, and I'll see you very soon. All the best. Bye.